Next article today is Fed holds rates steady and indicates 3 cuts coming in 2024. With the inflation rate easing and the economy holding in, policymakers on the Federal Open Market Committee voted unanimously to keep the benchmark overnight borrowing rate in a targeted range between 5.25% and 5.5%. Committee members penciled in at least 3 rate cuts in 2024, and that's less than what the market had been pricing in, but more aggressive than what they had previously indicated. That's great news, number one. Number two, honestly, if I'm being completely candid,
please.
And I did not tell you I was going to do this, like, I honestly am concerned about them cutting rates that soon. And here's why. We started this little process in March of 2022.
Yeah.
So here we are in December of 2023, 21 months later.
Yeah.
Now, we've had a couple of pauses, and then we're looking at maybe a cut in March or a cut in May. There's a lot of data that has to soften in order for that to happen over the next 90 days.
Yeah.
Or 120, 150 days, which sounds like a lot, but it really isn't a lot, you guys.
Yeah.
Look how fast Christmas came upon us. Look how fast the fall was gone. Look how fast we're already in 2024. So I think it's nice that these Fed members are saying this, but again, because they're making data-driven decisions, I am hesitant to get 100% on the bandwagon on that.
I think so too. I think there's a lot of pressure everywhere, and Uncle Powell seeing that. There's a lot of pressure. The only thing with Uncle Powell, he's got a big ego. He doesn't just get influenced that easy, You
think so?
I mean, we've seen it, right?
Yeah.
Like he just kept hiking, and look.
Yeah.
Now I think, okay, all that pressure is just putting him in a position where I think we're going to start kind of easing into doing those rate cuts. But, early on, maybe a couple of weeks ago, we're hearing 5 rate hikes. I mean, five
cuts.
rate cuts.
Yeah.
So,
those analysts that called for
now it's
5 rate cuts. I'm like, man, that seems really steep. Even if they're 5 quarter points, that takes you all the way back down to 4 on the Fed funds rate, or it would take you back to 4. That's pretty aggressive. But and my initial thought to that was, well, something would really be going wrong if they have to do that quickly, because that's also 5 out of what do they have, 8 meetings throughout the year or something like that. So out of the 8 meetings you're going to have, 5 of those are going to cut. That might be a little too aggressive right away. But this is really a story of inflation. Whether they intended it to work this way or not, I think they're getting some help from inflation.
I agree.
They did add this qualifier that inflation eased over the past year while maintaining its description of prices as elevated, and that they see core inflation falling to 3.2% in 2023, 2.4% in 2024, then to 2.2% in 2025, and finally getting back to its 2% target in 2026.
Jeez.
Hashtag quick reminder for all of you, it says the word falling, but this is still an accelerant measurement. There's still a positive plus sign in front of each of these numbers. So that means that inflation will still be going up by 2.4% in 24, up by 2.2% in 25, and then still positive 2% in 2026. So slowing does not mean reversing. Have to clarify that. Had to answer those questions in the comment box as well, which is fine. But just be cautious when you're looking at videos like this and you're watching graphs and you're looking at charts. If it's in positive territory, it's cumulatively positive. Yeah. It'd be like my weight going up 2% per year. It's still going up. Hey, until that weight goes down 10%, that 2% up is just up and up and up and up.
Oh, no. We don't need that, Andy.
Yeah, we don't need that.
I know the holidays are here, but let's not have an excuse of why to gain 2%.
Yeah, coming into the end of the year, we've had a lot of shows this year. We know this has been our first full season kind of in this format. Yeah. We have talked about the Fed a lot more than I wanted to, but it is kind of what comes with the job. This is what we have to do to inform people and then translate that and what that means to people in home ownership
and that's what's happening. Everybody, I mean, the Fed they're influencing everything. Everything we buy, anything we do, I think it's good information for the people to know. Yeah. It's good for us to also know. Well, because in that way, we're just figuring out a way how to encourage people with data.
Well, and think about the people that, they might have gotten ridiculed or criticized for pulling out that HELOC in 2023. Well, if that HELOC is on a variable, which it is, and it's going to be Fed funds rate plus prime or whatever it is, and that it's going to be going down. So your monthly cost is going to be going down as your balance is going down, and your debt service every single month will be less expensive as long as you're not charging up that line of credit. But this is a force function of looking at 3 rate cuts in 2024 is you're going to see that those payments are going to be lower in order to debt service, not higher. So I think that's a positive coming out of this as well.
Yeah, and being that, consumer debt is at its highest ever in history, ever recorded in history, I think it's going to be a huge benefit, win-win in many many ways.
Yeah. Yeah, so. And I know we saw last week we talked about the CoreLogic Home Price Index report, and that had house prices up for 2023. It's a Q3 reading, so it is a look back of Q3 of 2022 versus Q3 of 2023, and that home prices were up, and they had accumulated another $1.1 trillion of home equity in that same time, which is about the same amount of consumer debt we have. So, hey everybody,
hello,
hey, you can redeem that $1 trillion equity and pay off all this consumer debt,
please.
That consumer debt is not spread across only homeowners. So qualifier for those of you who want to comment, we know that's not all homeowners that carry debt.